RIVN beat on revenue, raised guidance, and then dropped about 8%. So the question everyone's asking, was that sell-off fair, or did the market get it wrong? Today I'm giving you a straight answer, defending it, and then telling you exactly what would prove me wrong. Important, this is one analyst's opinion, for education. Not financial advice, and not a recommendation to buy or sell anything. Let's go. Here's my call, up front, no suspense. I don't think the sell-off was unwarranted. But I do think the market sold it for partly the wrong reason. Those are two different claims and I'm going to defend both. And I'm going to start with the side I disagree with, because if I can't make the bull case sound strong, I haven't actually done the work. So, if you think this drop was dumb, here is your best ammunition, and honestly, it's good. Look at this trend. Automotive gross margin, negative 36% a year ago. Then negative 11. Negative 7. Negative 7. Now negative 3. That is 5 straight quarters of improvement in the same direction. And the automotive gross loss shrank from $335 million to $36 million. That's an 89% reduction in the loss in 12 months. That's not noise. That's a trend. And then they did something companies almost never pull off in the same quarter. They raised their full-year delivery guidance by 3,000 vehicles. They improved their EBITDA outlook by $50 million. And they cut their capital spending forecast by $250 million. Think about that. Normally, promising more volume means promising to spend more. Doing all three at once is a genuine sign that operating leverage is showing up. Deliveries also came in at 12,194, versus their own guidance of 9 to 11,000. They beat themselves. Okay. That's the strong version of the bull case. Now here's why I still land where I land. And it comes down to one sentence: the trend is great, but the level is the problem. That negative 3% automotive margin? It includes about $106 million of regulatory credits, emissions credits sold to other automakers, which is basically free margin with no cars attached. Strip those out and the actual vehicle business is running somewhere around negative 14% product margin. So we're not almost at break even. We're still meaningfully underwater on the thing the company exists to build. And the profit that does exist is borrowed from somewhere else. All $215 million of gross profit came from software and services, and that revenue is largely engineering work for the Volkswagen joint venture. That's a contracted partner program, not a scaled software business throwing off recurring margin. Useful, real, but a different thing than people assume when they hear software. Now here's where I think the market's reasoning was sloppy, even though I agree with where it ended up. Almost every headline blamed dilution, the 75 million share offering. But that offering was announced 3 weeks earlier, on July 7th, and the stock already fell 14 to 17% that day. Selling again on the exact same fact is double counting. That information wasn't new. The genuinely new negatives were quieter, the CFO flagging rising raw material, memory, and logistics costs, with memory getting squeezed because AI data centers are hoovering up the same chips. Right destination. Lazy route. So here's the honest scoreboard, both columns. Bulls are right that margins improved dramatically, that guidance went up while capex went down, and that R2 is landing well. Bears are right that the cars still lose money even with credits, that all the profit came from software, and that they burned $849 million and diluted shareholders 6% at $15.50. Both columns are true. Which one you weight more is the entire argument. So what tips it for me? Not the margin trend, and not the dilution. It's the clock. Gross profit was $179 million. Operating costs were $1,015 million. That's roughly an $836 million hole every quarter. Free cash flow, negative $849 million. Cash went from $7.5 billion to $5.3. And the Georgia plant this dilution is funding doesn't produce a vehicle until late 2028. Which means more share issuance isn't a tail risk, it's a reasonable base case. And that's exactly what the market is pricing. So my reasoning is this. When a company has negative product margin, needs at least 2 more years of funding, just diluted at $15.50, and then gets hit with input cost inflation in the same week, skepticism is the correct default. The burden of proof sits with the company, not the shareholder. That's a judgment call, not a fact, and you're free to weigh it differently. But an opinion without a test is just noise. So here's exactly what would change my mind. 4 things. 1. Automotive gross margin excluding regulatory credits. The clean number RIVN doesn't put in the headline. It needs to visibly march towards 0. 2. R2 reaching positive gross profit exiting 2026, that's management's own stated target, so it's fair to hold them to it. 3. Quarterly burn actually shrinking toward their EBITDA guide. 4. No new equity raised before the government loan money draws. Clear the first 2, and today's skepticism looks like a mistake. So, bottom line. I'd call this a proportionate reaction, not a panic. The direction is genuinely encouraging. 5 quarters of margin improvement is real progress that deserves credit. The distance remaining is also genuinely large. And an 8% move in a stock that averages 15% after earnings, on a day when Lucid also fell 6%, is fairly ordinary repricing. That's my read. Reasonable people look at these same numbers and land somewhere else, and that's fine. That's what makes a market. One more time, this was opinion and education, not financial advice, and not a recommendation on the stock. Do your own research and talk to a licensed advisor before risking real money. If this was useful, like and subscribe. See you in the next one.